Nico, warm welcome. Thank you for being with us today. Should we start a little bit and tell us about your fund or your firm?
Thank you, David, for having me here. And my name is Nico Goulet. I'm a founder and managing partner of Adara Ventures. We are an early stage venture capital firm, been around for the last 15 years. We have 3 funds under management in our flagship line of funds, 180 million under management euros, and we've done 40 investments to date. Very much focused on what we would call tech-first companies, so cybersecurity, data analytics, ML ops, digital health, semiconductors, etc. So the hardcore stuff.
We know that venture is about taking risks, so some of these companies are not going to be successful and some of them hopefully are. How do you balance the risk in the portfolio? How do you move from an individual return to getting a return for your investors?
I think that's a really interesting question because it raises a whole host of secondary questions around it. Fundamentally, we believe that you have a period where you configure a portfolio and then you actually harvest that portfolio into a set of returns. And in the process of selecting the companies you're going to include in the portfolio, you have to have a certain amount of balance between geographic diversification, sector diversification, maybe stage diversification, and you're going to try to fit that portfolio into your investment thesis and strategy to try to maximize the returns. And that's the part where you're picking companies for your portfolio, right?
You might turn something down because even though it's an attractive investment, it doesn't fit
Totally.
your portfolio.
Yeah. So coherence and consistency is super important in that phase because you want to have a balanced portfolio. When you look at it, you have to see that it has some checks and balances in it in terms of the different risks that you're running and so on and so forth. Second phase of that is how you allocate the portfolio. There were sort of 2 types of VCs in the world. There are the pickers and there are the allocators. The pickers are the ones that believe that they select individual companies for their success. Allocators are going to build a portfolio and then allocate funds across the portfolio in order to maximize the returns. What it means in practice is that there's a fundamental sort of, I guess, power law within a portfolio in which if you can shift dollars from underperforming companies to overperforming companies in terms of the investment, you can increase the returns of the fund. So in an allocation process, first of all, you need to be able to allocate. So you need to have a progressive deployment of your investment. So you need to maintain funds for follow-ons, basically, this is what it means. And secondly, when you do the follow-ons, you have to have a very rigorous criteria in terms of balancing out the way you try to identify the winners so that you overweight the winners in your allocation, right? So which is how do you compare the companies in your portfolio? What it means is that every member of your portfolio becomes an investment in which you need to compare it to all the other investments to try to identify which one is going to be the better investment. Not the better company, but the better investment. And what that leads you to is to have to put a little magnifying glass on it that is kind of independent of the company. Let me give you an example of this. You can have a great company that's a bad investment. And it's actually quite easy to do that. You just have to overpay in your initial investment. And it can quickly become a very good company, but a pretty average or even a negative investment, depending on what the market does to you. And you can have an okay company that becomes a great investment. If you've come in at a very early stage and you're capable of keeping the track, and when the value creation in that company is actually concave, not convex, you will actually probably have a good investment. What you need to do is figure out your companies and compare them along the investment axis, not along the performance as a company. I sometimes say VCs that talk about unicorns are VCs that are pickers because they're trying to pick companies based on whether they're going to reach unicorn status individually. Dragon hunters, and the definition of a dragon is an investment that returns a whole fund, are focused on the allocation because what they look for is the characteristics of an investment that returns the whole fund. Let me give you an example. You have an investment, you get 10% of a company in the initial round. That company grows, it becomes a huge company, potential to become a unicorn. Unicorns actually have one characteristic, is that they actually need to feed themselves a lot. So what you're going to have is a lot of dilution. Maybe that 10% becomes 2%, becomes a unicorn. You have a 20 million NAV in a fund of 50 million. So you return 2/5 of the fund. Take another company in which you start off with 10%, but you're able to maintain your pro rata, and you keep it at 10%. Company goes to 500 million, you get 50 million back, you have a dragon. That's actually a much better investment than your unicorn. When you see VCs talking about whether they are hunting for unicorns or hunting for dragons, that's an indicator of the underlying strategy being more focused on picking companies versus allocating and building up the portfolio returns as a whole.
One of the differences between venture and private equity is that the entrepreneur sets the amount of capital that they're looking for when, and as you know, I'm out to raise a round of 5 million or whatever the number is. From what you're saying, you're trying to take back control of that and saying, actually, I want to put more wood behind this arrow, and you might form your own judgment about how much capital the company needs.
Well, in general, you think you need to match that up, right? So a VC should not push an entrepreneur to raise more if he doesn't need it, and an entrepreneur should not try to raise more.
But isn't there a difference between perception and reality? Because he may perceive that he needs less, but actually could do with more.
If you ask me, it's actually not how much you raise, but how much you spend, which is important. So if you can raise the same amount of money or double the money for the same dilution in a round, because the market is frothy, and that's what's happening now, undoubtedly it's good for everybody in the cap table, including the founders, including the investors, if you do that. The question is, how do you spend that money? And if you spend that money with a capital efficiency approach and you don't change your degree of capital efficiency as a founder, thinking about spending as little as possible as late as possible, which is generally the rule that maximizes return, you then will basically create more runway or be able to do more with that and really create a higher value for your investors. If all you do is spend that in a less capital efficient way and you end up at the same place as if you had used up a normal round, then you're going to be worse off.
You like entrepreneurs who are modest in terms of the way that they spend?
We like them modest on the spending, bullish on the value creation. So we want entrepreneurs that want to be disruptive and create very large companies, but we want them to do that with a very pragmatic approach to the way they spend. We're not big believers in this is one of the reasons we don't invest in the consumer market, because the consumer market tends to be a market where you acquire customers and where the acquisition rate of customers is very much defined by how much money you have. In an enterprise market, your acquisition rate of customers can be and generally is more defined by the amount of value you create for your customers than by the sheer amount of money you spend it and throw at it. Obviously, all within reason, right? You need a certain amount of money to create your distribution channels. You need a certain amount of money to be able to create your sales force. All of those things are very important, and you need to have good metrics of your sales and your unit economics. But in general, you don't have these massive amounts of money that can be spent and depleted in sort of identifying what your customer is doing. That process tends to be more capital efficient in the types of companies we do, and therefore, yes, we like entrepreneurs who are more focused on that aspect of the value creation.
Very interesting to hear about the difference between allocation and picking. But Nico, thank you very much for your time today.
Thank you.